Hello and welcome to our keynote in conversation on DLT and the future of intraday liquidity. My name is Lewis McLellan. I'm the editor of the Digital Monetary Institute here at OMFIF, and we've got a very interesting topic today and two very insightful and illustrious panelists to discuss it. I'll let them introduce themselves. John?
I am John Velissarios. I'm a managing director based out of London, working for Accenture, and I look after our digital asset, digital currency business for the firm globally, and been working in this area for a number of years with a number of leading organizations.
Fantastic, thank you. And Jennifer?
Hi, I am Jennifer Peve. I'm the Global Head of Strategy and Business Development for DTCC. I have overall responsibility for corporate strategy, strategic partners, and corporate development, innovation, strategy, and design. As a 30-year veteran of the capital markets industry, I've had the privilege of driving innovation across multiple asset classes, business models, and capabilities, and DTCC is no different. And as the lines between new entrants into the digital space and the regulated financial institutions starts to blur, I think it's really important more than ever that we really understand deeply emergent technology, new business model opportunities, and how we can really create a more efficient capital markets industry.
Fantastic, thank you both. So we're talking today about intraday liquidity. To set the scene a little bit, could you talk us through what you see as some of the problems or the inadequacies about non-DLT ways of doing it, the ways that they've been done and are still being done for many years? Jennifer?
So, I'm going to turn that question a little bit on its head. So I actually think it's quite a big mistake to mix up, a specific technology with the value of any function that is provided to the industry. So, at the end of the day, if we want to make improvements around things like intraday liquidity, it doesn't matter, in my opinion, what technology you use. I think that there are opportunities to just actually hit home on what the actual value is that clients are looking for at the end of the day, right? And if most clients are looking to have more efficiency with their capital and or better access, et cetera, I think it's important to look at the different ways you can make that happen. And DLT is certainly one of them, but I wouldn't suggest, I would just hesitate to suggest that not all non-DLT systems effectively result in challenges for intraday liquidity. I think today, efficiency credits and debits are accounted on an intraday basis, and we net at DTCC in particular, we net within accounts and within settlement bank to deliver that single end of day cash settlement to the Fed. And while we've talked with the industry about many different opportunities to optimize that process, we've had conversations around things like intraday slices for settlement, so creating multiple settlements throughout the day. The general response to us from a client standpoint has been that that's not desirable, right? There's risk in that for certain participants. And so I think finding that right balance between how you deliver those efficiencies, the technology you deliver them on, where you're actually getting the clients are getting the value that they seek is quite important. And I think from our perspective, we continue to have those conversations with the industry, but and make improvements where we can.
Yeah, thank you. Yeah, I think very important not to just treat it as an entirely technical problem. It's about what people actually want from it. Sorry, John, you were going to say.
Yeah, no, I was just going to absolutely agree, and I think that there's a risk that we end up sort of trying to solve a problem just by looking at the technology behind it. And I think here it has to be driven by the industry and by sort of what clients are looking for. And in many cases, it isn't appropriate to actually look at and say we wanted DLT will solve this problem. It is one of the many ways that you can solve many problems, but at the end of the day, it really has to be driven by business requirements, customer requirements, the needs of the market, and the participants that are there. I would like to add, though, there's probably a couple of things that where we have seen certain attributes of some of the technology that enables things that are and functionality that perhaps isn't as easy to implement with traditional systems. And I think that's an area where to look at specifically where you can apply this new technology, and specifically around things like programmability, expanded access, where we see that as a capability of this new technology. Because if you're dealing with sort of assets and cash in a new format that can enable things that weren't possible before. And I think that's an area where we've seen applications of it in wholesale markets that have been really brought to life with this new technology and its innovation. So I think there's also ways to explore how you can enable these new kind of features as well as part of this.
I think that's actually that's a really important point. If you think about other asset classes, we tend to always focus on securities when we talk about this topic. But when you look at other asset classes and you look at some of the balance sheets that corporates have, for example, and if they wanted to better leverage some of the excess balances that they have, something like creating a liquidity facility, leveraging a real-time technology like DLT, with the right participants and the right structure around it, there are some opportunities for them then to be able to potentially lend out some of their capital so that they can get better efficiency and better use of it, right? Versus it just sitting around.
Yeah. This concept of the efficiency of efficiently using capital and not having it just sitting there is something that comes up a lot here. Can you just talk a little bit about why that is a feature of the current system and why it's necessary and what we could do to improve and use it more efficiently?
So if you ask me from a US perspective, again, and I do think on a global basis, this has some very, there's different answers to this question, which is also why when I think about the blockchain and I think about how we approach it and talk about it, it's really important to be very clear about exactly what we're talking about it in terms of the use, right? So if I focus on US equities, for example, I think it's really important that we continue to maintain netting of the US equities transactions for operational efficiency, right? We have a 98% netting efficiency around US equities, and that means we significantly reduce the settlement risk and the settlement transactions that run through the system. And while we've had a number of conversations with clients around accelerating settlement, like I mentioned earlier, intraday slices, how do we just create more efficiency? What do our clients want at the end of the day? What is that value they really want at the end of the day? How do we get them that? I think instant settlement with our US volumes is not something that most participants really get behind. And the reason is if you have 200 million sides a day and peaks of around 25,000 transactions per second, instant settlement, right, would introduce a lot of risk into the market, not reduce it. And our whole goal when we innovate should be about how do you introduce value, create value, drive efficiency, reduce cost, but also not introduce systemic risk into.
Sorry, can you just clarify what the risk of that kind of volume in instant settlement? What is the risk that's introduced by that?
Well, so today, right, instant settlement, wouldn't really support the financing of transactions. So, if clients would have to have cash and securities on hand at all times, as opposed to, the stock lending, function that exists today, I'm not saying it couldn't exist. It just right now, the way it works, it would not work for instant settlement, right? And if you are settling 25,000 transactions per second, that means or if you are clearing 25,000 transactions per second, you're settling them as well. So that's a number of transactions that are actually going through the settlement system, and risk for failure, right? So if firms don't have everything completely pre-positioned.
Yeah, right. Yeah, pre-funding is key, and at the end that is a huge burden on many of those kind of trades and participants, and given the volume, I think that could introduce its own, as you point out, Jennifer, its own risks that are quite difficult to sort of account for or justify, given sort of maybe the benefit that's associated with it. I would like to actually just maybe raise a point, though. I think that there are I guess like any new kind of development and innovations in this area, there are, when you look back and you say, well, how was the internet, envisaging sort of the way the internet was designed and developed and how we're using it today is very, very different. I think with this kind of innovation as well, I think it's equally applicable, because at the end, I think there's a lot of new sort of capabilities that could potentially be enabled for a segment of those trades and of those transactions and for the market, which could enable entirely new business models, new business processes, and enable through this technology. And I think this is something to explore as well, because it could open up a whole new area of different type of trades, and create its own marketplace as well, on top of what we already have. And I think this is also an area of interest, and we see this specifically, obviously, in wholesale markets and also for these kind of transactions. And it may not sort of address the large volume of DTCC trades and transactions, but maybe in the future it could be a small portion of that could begin to grow and emerge as new business models develop on the back of it.
Yeah, I think that's a good point. And I think again, when I talk about I guess if we talk about the ideal system, right, then ultimately a lot of what we have in terms of market structure might look a little bit different than what we have today. But with what we have today, I think getting to a T0 end of day net settlement, I think is definitely something that we talk to clients about quite a bit, and think about how do we start to move towards that direction, still driving the benefits of netting for that overall efficiency on operations and settlement, but at the end of the day, kind of reducing further the risk, the counterparty risk on those or settlement risk, on those transactions, and getting us closer to something that is same day, not necessarily real time.
Yeah. John, I'd like to go a little bit. I mean, the concept that you mentioned there of these additional models, I guess, new types of business models, new types of transactions. Can you go into a little bit more detail on what these might look like and why they're an emergent property of a DLT-based system and not possible with the present-day system?
Sure. I mean, I think a couple of very high-level items. I think one is around sort of programmability and the ability to create maybe more complex business logic associated with a trade. So nesting transactions, cascading trades, building these kind of new sort of financial transactions, I think, on the back of DLT and the programmability and the smart contracts and the programmability aspect of it as well. When you embed the money and the settlement side in the form of a tokenized or CBDC of a particular flavor, you're able to then address the settlement component of it in a delivery versus payment model, and it de-risks the entire sort of transaction and so on. So I think there's a lot of benefit with regards to these kind of new type of business models. Of course, you're introducing complexity, which of course has risk, and so you need to make sure that those things are properly addressed. However, that kind of business logic, I think, can really come to life as you develop these, as you sort of leverage this new technology. The other dimension of it as well, and I know maybe it's not necessarily a direct immediately directly applicable to maybe a US model, but we've seen this as well in other markets where if we have sort of digital currencies, central bank digital currencies as part of the transaction and the settlement process, what can you do if you're allowed to then sort of transact it in another jurisdiction? Can you then move these transactions into another market? Can you trade them, settle them without sort of without the associated risk directly by different participants? Having access to that sort of monies and also the securities in these kind of sort of in these new sort of developed models, could be very interesting and open up the market on a much more international level. We've seen that through the project Jura that we've worked on with Portugal and then in France, with central bank money and digital assets and currencies and so on. But the interesting part of that was the extra jurisdictional component of that and being able to trade that and perform that transaction in another jurisdiction. And that was possible because of what we had leveraged in terms of this technology development.
Fantastic. Yeah. Jennifer, you were talking just there about instant settlement and what we're really wanting to move towards. When you speak to a lot of people promoting blockchain settlement systems, atomic settlement is very much a core part of the value proposition. How do you but as you've already mentioned, that the idea of instant settlement can introduce a lot of risk to a system where everything has to be pre-funded. How do you see DLT kind of reconciling those two concepts of instant atomic settlement and netting, the value of netting?
Yeah, so actually I want to also mention a couple other things, so I'll cover this all together. So the first thing is, when we talk about, instant settlement and liquidity and things of that nature, we always tend to go to the post-trade process, right? We tend to go to what happens in clearing and settlement. But the reality is this actually all starts at the exchange level, right? At the trading, at the front office. And if there are options for, liquidity pools around T0 settlement, T1 settlement, T2 settlement, then it makes that downstream, it makes it much simpler, right, to affect that downstream settlement process, right? So ultimately today, most of our markets in the US, they have T2 settlement when you trade, and so those come in as T2. You can obviously do things on an accelerated basis that are more OTC and send those in, but that's what makes it a little bit difficult, right? So then you start to think about, well, what market structure changes actually need to occur in order for us to really have a very efficient end-to-end trade to settle system. And so here's where, I think, John was mentioning some of the new business models we have in the US started to see a new exchange pop up that is going to offer, settlement dates that are not at just T2, right? And so that right there starts to open up some ease of transaction to settlement in terms of just the overall, like, how do we make sure that, everyone's agreed up front, and then you can settle and you have greater certainty on that front. So that's one element. I think the other thing is FX considerations. So John talked about CBDC or stablecoins, et cetera. So now if you want to really operate on a global basis, we have to consider what the FX and positioning of securities are for settlement around that aspect, right? And so on a more accelerated basis. All these things are, these things over time are solvable, but they are market structure changes that have to occur, and you need clients to really rally around these changes, regardless of the underlying technology. Again, this is more about how the market wants to operate, not about the technology that we want to use. Now at DTCC, we have started, over the course of the last couple of years, my team had started working with the clearing and settlement business around a Project Ion, which was, focused on how do we leverage DLT to help accelerate settlement, and what does that look like for us and the participants? And that project has now moved into MVP status. It's under development, and through that process, as well as our larger modernization effort, we look at all of the workflows, the processes within the entire tech stack, and we're talking with the industry quite regularly about how we address the practices of how trades settle, right? Because that's what this all really boils down to. And so I think, we have, definitely some interesting opportunities here. Ion being one of them, where the industry now has the opportunity to see how, trading platforms that have these prescribed T1, T2, T1, T0 settlements attached to the trades could come into, Ion for settlement, on a tokenized basis. And I think as we start to evolve and we start to see kind of what the demand and the opportunity there is from clients, that will really then dictate how things continue to evolve, I think, from our perspective, but that will also then drive some further changes over time in the market structure. It will have to, right? Because, again, this is not really about technology. This is about just how we all operate.
Yeah. I can bring in a question from the audience here. So Manfred E. Will, from founder and CEO of MEW, has asked, with wholesale instant payments fully rolled out, bank runs can be as short as 30 minutes, 24/7. From this perspective, doesn't T+1 sound far too long for counterparty risk? Shouldn't risk and risk management and settlement match at all times? So is there a risk of a mismatch here, within that creating a vulnerability? So
again, I think in a clearing system, we're talking about guaranteed transactions, right? So your guaranteed settlement, et cetera, right? You've got that clearinghouse guarantee. So when I think about, is T1 too long? Again, this is why we've got something like Project Ion and MVP. It's to experiment with, if the industry wants T0, then let's see we want to see the activity and the demand through, exchanges and our clients, right? Like, help us understand where that's coming from. At the end of the day, if you have, and again, I'm talking very US centric, right? There are likely opportunities on a global basis where either the volumes are smaller and whatnot, and so there could be different opportunities. But when you look at asset classes broadly, there's plenty of asset classes that settle on a T1 basis, right? That settle across the board, on the derivatives side as well. So I think it's really not for me to say whether T1 is too long. I think, again, I leave that to the industry to help drive us in terms of the value that they want to see out of the transactions in the process.
Yeah. John, where are we? We've kind of touched on this a little bit, but where are we in what's the timeline for DLT based systems being deployed for something like this? What's the development trajectory?
Yeah, I mean, I would say that in the grand scheme of things, this is still very early days, right? I mean, at the end, we've gone through a series of experiments and conceptual sort of projects, and we're still in the middle of many of them as well. I think at the end, it's because some of these are very complex topics, and as Jennifer points out, they have to be driven by the market demand, right? At the end, if you implement something that nobody signs up to or uses, I mean, I think it sort of makes a point about the relevance of it. But at the end of the day, it's sort of an iterative process where you experiment, you implement, you test the market, you create the demand, and you also need for the market to become more mature as well, to demand these kind of services or to demand these kind of sort of innovations for the things that they are trying to achieve as well. So exactly like I said before, around sort of these new business models that could develop on the back of it, I'm sure clever people will figure out that there are a few really innovative ways to develop new financial instruments with this new technology on top of in these regulated marketplaces as well. So I think that's just the background behind it. But at the end of the day, in terms of the deployment, there are a number of technology sort of solutions in the market. DLT has been around for years. We've been implementing them at scale. We've been developing them in terms of the non-functional as well as the functional aspect of it. But I would like to just raise a point. I think here it's not just about the asset side, but definitely about the digital currency side, the CBDC side of it, and the currency dimension of it that enables that sort of settlement to take place. And I think that is predicated, the deployment of that is sort of predicated by who's going to be the issuer of this digital currency. Is it a central bank? Is it, in the case of the US, the Fed? Is it a stable coin? Is it a commercial bank? Who exactly is the issuer of this? And in other jurisdictions, what's the role of the central banks that are in those markets respectively? So I think a lot of it has to happen in order for it to take off, because otherwise you're introducing a different kind of risk into the settlement process. And I think that's also what we're trying to address here too, trying to de-risk and deploy these. So the timeline is going to be, I think, related to obviously how the cash settlement side of it sort of bakes into this overall solutions, and I think that has its own sort of trajectory and timeline associated with that. Yeah. In addition to it, of course, then you're talking about sort of the industrialization of these kind of platforms and the ability to deal with the volume, the sheer volume, and then also the market demand and the kind of application. So sorry, that's a long-winded answer. Yeah, but there's a lot of things in there as well, and I just want to mention a couple of key points that sort of also sort of play into all of these conversations as well. Is around sort of which platforms. I mean, there's a number of platforms that are out there. Do you sort of pick one versus another and versus another one? And I think there's an element of standardization, interoperability, as well, and other non-functional things that have to be considered as well, including things like security and a number of other performance-related topics.
Yeah, I mean, on the cash settlement front, I guess this week with the collapse of US Terra, one of the biggest stable coins, anybody who was imagining an infrastructure built on stable coins, particularly algorithmic stable coins, is probably going to be hoping the central bank steps in, I guess. But yeah, I guess we'll see. Jennifer, anything you wanted to add there?
No, I mean, I support John's comment on, as you think about the different technology protocols out there with regards to DLT, we actually created a framework and we had over 100 different protocols and platforms that we looked at. And when you boil them down, like you have to really understand what fits for your business in order to evaluate those platforms, because, for someone like DTCC, highly regulated, safety, soundness of markets is our first priority. And so, as we start to think about blockchains, we have our own requirements that we match up, but, just kind of really being thoughtful about what's out there and what's going to meet your needs and your client needs is quite important.
We're running fairly short of time, but I think we can squeeze in a question on what are the regulatory developments that need to be forthcoming from regulators. We can start in the US, but maybe other jurisdictions as well, in order for DLT systems to be implemented and you to get to achieve the sort of benefit that you're talking about.
I'll just briefly say, across our initiatives, we have made a concerted effort to ensure that what we deploy is regulatory compliant, given our existing requirement, given the existing rules today. And I think that's feasible, right? I think there are ways to move this technology forward with that in mind. Certainly, when it comes to things like stable coins and ensuring, like, if you want to use stable coins for any type of collateral or settlement, you've got to ing that underlying asset, whatever it is backed by, is there, not just synthetically there. I think having some clarity, I think, around the use of those types of instruments for further settlement, et cetera, it's important to understand, right? If you have a one-to-one, then that's probably fairly simple. But if you're looking at something a little bit more complex and sophisticated, I think just knowing how that's going to be impacted by the regulations is important to know, or it would be important to know.
For sure. Yeah, definitely a lot of clarity needed to emerge there. Yeah. John?
Yeah, just to add to that, I think there's something to consider as well, that as we sort of expand and we maybe the scope of this and we include the cash settlement tokens and digital currencies and so on into the mix, are there new regulators that come into the scope of the services you're providing at the end of the day? So if you're you may be operating entirely within the existing regulatory boundaries, but you're introducing potentially new regulatory scope and even if it's the ability to operate this in other jurisdictions, what does that mean at the end of the day? Now you have different participants perhaps into the mix. Does that create additional regulatory scope for you to consider as part of these solutions? So I think that's also something to be very mindful of. Obviously there are the existing regulators, but any additional regulation that may be coming into effect as a result of new services you're providing with this kind of technology.
Yeah, and presumably the expanded access that you're talking about with Project Jura requires a lot of regulatory interoperability, I suppose. Yeah.
Indeed.
Yeah. Well, we are pretty much out of time, so I think we should wind up there. But thank you very much. Really fascinating insights into well, a huge market, and one with a lot of potential for savings with the more efficient use of capital, and a lot of possibility for growth. But yeah, I think a really important takeaway for people to not focus on this as a technology problem, but as a means of working out what people actually require from this marketplace and what's actually desirable. Fantastic. Well, thanks very much, guys. I just want to say for the audience, thank you for watching. And coming up, we have a presentation from RTGS Global from Victoria Cummings on transforming international payments. That's running from 11:30, just about to start. And then at 12 o'clock, we have our panel on global cross-border payments from targets to execution. So please do stay tuned for those. Enjoy. Thank you for watching. Goodbye.